In this video, we'll look at a way to build a resilient portfolio, a portfolio that you can keep for the long term, which has historically had good return, but hasn't been prone to long, deep crashes. This video is sponsored by InvestEngine. As always, bear in mind that the information contained in this video should not be construed as financial advice, and you should always do your own research before investing. So what do we mean by a resilient portfolio? A good portfolio may generate good long-term returns, but if you can't stick with it over the long term, then it's of no use at all. And to misquote Yoda, long, deep crashes are the path to underperformance. And that's because our willingness to invest may be dashed by large losses. Disillusionment leads to underinvestment. And if we don't invest our capital, we can't generate returns above the cash rates which we generate from cash sitting in our bank accounts, for example. However, a diversified strategy is not without its own drawbacks. The problem with a diversified fund is that there'll always be something which is performing better, and sometimes single stocks or sectors will be performing a lot better. But it does help to remember examples like Tesla, where periods of very strong performance led to underperformance later on. Also, while diversification can mitigate losses, it can't exclude the possibility of loss altogether. If you don't want to generate any losses at all, then cash sitting in a bank account is probably a more appropriate investment. Money market funds are also very safe and very unlikely to crash. But again, it helps to remember that with safety comes low, long risk return relative to stocks. And finally, although you can look at the long-term returns for a strategy, it helps to remember that that doesn't always predict what will happen in future. Hence these financial warnings that you get in videos about investing. Now let's look at some resilient portfolio examples. Various portfolios have been created over the years for generating good returns without having long, deep crashes. These would include the all-weather portfolio created by the famous hedge fund manager Ray Dalio, the golden butterfly portfolio that I've made videos about in the past, but also the portfolio which we'll focus on today. Now don't be put off by the name, it's called the weird portfolio. I'll come on to how to build your own resilient portfolio in a moment, but today's video is sponsored by InvestEngine. InvestEngine is an award-winning UK investment platform, and the first reason I became aware of it was that members of my own PensionCraft community were raving about it. One of the reasons that my community members gave for liking the platform was its very low fees for its ISA. If you have a portfolio which you manage yourself, it charges no setup fees, no withdrawal fees, and no dealing fees. InvestEngine offers a wide range of ETFs, with the current list standing at over 600 exchange-traded funds. Do check out InvestEngine's own education series. I've worked alongside them to make some of those videos. And if you're a PensionCraft viewer, you'll get a welcome bonus of up to £50 if you invest over £100. Terms and conditions apply. If you transfer an ISA to InvestEngine, you can earn a bonus of up to £2,500, and that depends on the size of the transfer. This offer is for new or existing InvestEngine clients, and terms and conditions apply. And to learn more about that, simply click on the link in the description below. Coming back to the weird portfolio, there's an entire booklet written about this strategy, and this is freely available. And my podcast co-host and I, Michael Pugh, interviewed its creator on our podcast Many Happy Returns. He goes under the pseudonym Value Stock Geek. The portfolio has 5 ingredients in equal amounts. Small stocks that are also cheap, so that's called small cap value. International small cap stocks. Long-term government bonds. And then finally real estate investment trusts and gold. And all of these ingredients can be bought in the form of inexpensive funds. So how long and deep are the crashes of this portfolio if we go all the way back to 1970? On the Portfolio Charts website, you can see that the longest and deepest crash was 22%, and the duration of the crash was 5 years when expressed in US dollars. That compares favourably with a pure US stock portfolio, for example, where one particular drawdown lasted over a decade between 2000 and 2012. If we express the statistics in sterling, the results are slightly worse. The longest lasting crash over this 54-year period was 6 years in length, and the size of the fall was 27% at its deepest point. However, if we look at all 20-year periods since 1970, you can see that the worst annualized return was 5%, and that was for the period between 1971 and 1991, and the typical return was a respectable 7% on average. And that's a return above inflation, and this data is from portfolio charts. So while its author describes his portfolio as weird, this has actually produced very good returns and very consistent returns over this historic period. But how about other strategies? The simple fact is that there is no single best strategy. All the historic return tests tell us is roughly what returns to expect in future. For example, while the golden butterfly portfolio doesn't appear as good as the weird portfolio, but importantly, it was unusual for it to fall by more than a 5-year period. In fact, that only happened in 4 cases over the last 54 years. How can we build a resilient portfolio in practice? In fact, it can be very easy. Portfolio charts also suggests funds which would be appropriate for each of its categories, as you can see here for the weird portfolio for UK investors. Although sometimes the fund choice isn't perfect. A website like Just ETF is also very useful for finding individual ETFs. After buying the funds in the portfolio, there's also a bit of maintenance required. If the portfolio gets too far out of line with the equal weights which it demands, then you can sell some of the funds which have risen in value and buy some of the funds which have fallen in value. This is a process called rebalancing. On InvestEngine, this rebalancing is very easy with a portfolio feature where you can achieve it with just one click. However, if you're not comfortable with building your own resilient portfolio, InvestEngine, the sponsor of today's video, can provide you with one of its own managed portfolios. Simply fill in their questionnaire and they do the rest for just 0.25% in addition to the costs of the funds. They handle all of the investment decisions and rebalance the portfolio for you. So let me just demonstrate how to fill in that questionnaire. It's very quick and easy. I just choose add a new portfolio. I'll add an ISA managed for you. And let's say I invest £10,000. What proportion of my total investable assets will this represent? Let's say 0 to 25%. Annual income, investment time frame, I'll go for long term. Maximizing profit or minimizing losses, which do I prefer? What would you do if the market makes a downturn? Of course, I'd buy more. And how large a loss could I sustain before it negatively affects my future standard of living? Would I prefer a guaranteed rate of return to uncertain returns? Probably. Will I need to withdraw any funds in the next 5 years? No. Which financial instruments have I invested in before? And it comes up with a selected portfolio. I can look at the projections and I can also look at the asset allocation. And I can also set up regular investing for this portfolio, either weekly, fortnightly or monthly. So in conclusion then, I think once you understand the relationship between return and risk, and also that investment is a venture that's most likely to succeed if you stick with it over the long term, then finding a resilient portfolio that you like and can live with is very important. Remember, there will be setbacks. No portfolio rises forever, however carefully constructed and back-tested. And there is no single best portfolio. You've just got to find one that matches your investment style, your risk appetite, and your investment horizon. But using historic returns to guide that choice is always a good starting point. Now don't forget our offer from InvestEngine, the sponsor of today's video. To find out more about that, just click on the link in the description. And, as always, thank you for listening.